The struggling economy has forced many to rethink their retirement plans. Some now find that they don't have enough money to stop working. Lawrence Hughes, chief executive of BNY Mellon Wealth Management, believes investing strategies have got to change with the economic realities. Good to have you with us, Larry, on Bloomberg. So what has really changed? I mean, we know about the sluggish economy right now, but wealth management, that's a much longer-term outlook, isn't it?
Sure, Pimm. It is a long-term outlook, and long-term strategy is important. But we think what's happened in the last 2 years is more likely to take place over the course of the next decade. We're thinking of the next decade as the critical decade. We actually think more investors are likely to fall short of their goals in the next decade than any time in the last 50 years because they have yesterday's plan. So in the past, you could take a set-it-and-forget-it kind of approach to your portfolio.
This idea of buy and hold, for example.
Exactly.
You buy the stocks, you put them away, and you just do asset
Exactly.
allocation.
You could take a 7 to 10 year look at things. You could have a good, solid asset allocation and strategy, and then you could fine-tune your portfolio over the course of that 7 to 10 years. Today, you can't do that. There's too much volatility. Markets move too quickly. Trends develop over the course of weeks and months and then disappear. So if you don't take advantage of those, if you don't work with a firm that has the global resources and capabilities and depth of breadth of capabilities, so you'll miss those opportunities. So you need to be able to capture them. You can also mitigate risk by being able to move quickly as well. So if you're taking a set-it-and-forget-it approach, you're likely to lose opportunities and take on additional risk.
Tell me about this whole idea of silos, because in wealth management, you've described how, at least in the past, most of the firms have looked at things in specific silos, and they haven't really kind of offered investors, a group of ideas.
One of the mistakes that investors make is they look at their investment portfolio as distinct from their tax situation, as distinct from their wealth transfer strategy, distinct from their gifting strategy, perhaps distinct from their liability management loans that they might have. We think you need to look at all of those things together. So you need an integrated and dynamic plan, a plan that you're constantly evaluating, taking advantage of opportunities, and looking across those. So, for example, today's really low interest rate environment, there's a terrific opportunity to use some of the charitable vehicles, GRATs and CRTs, things like that, that you can estate planning techniques that you can take advantage of today's low interest rates. And loan rates are incredibly low today. So you can borrow money on your personal balance sheet and take advantage of that for investing opportunities. So you really need to think across the horizons. As taxes rise and the environment changes, you really need to be constantly evaluating the different aspects of your life situation in totality, not in a single silo.
What about investor psychology right now? Because if we look at how investments have performed over the past decade, really, you could certainly make the case that investors just want to go and hide underneath a rock somewhere because the performance, at least in equities, has been flat. How do you make that first attempt to draw out the information from an investor? Because you're talking about information that is not only about what they think for investments, but also what they think about their lives and what they think about their families.
Right, Pimm. That's where we need to understand what is the objective that somebody has for their money. So, investors don't think of their money the way that we in the wealth management industry have traditionally talked to them. We talk to investors in our own terminology. We talk to them about standard deviation and R squared and risk.
Let me guess, their eyes just glaze over.
Exactly. So what we need to do and what we are doing in our firm is we're talking to them in terms that make sense to them. And that's how we get them be more comfortable moving back into the market. So, for example, investors think of their portfolio as how much money do I need to maintain my lifestyle in this incredibly low interest rate environment? How can I maintain an income that supports what I worked my entire life to achieve? So we talk to them in those terms about your lifestyle. Then we talk to them in terms of their wealth transfer portfolio. What is it that you have? What are your objectives long term? Do you want to fund something for your alma mater? Do you have a favorite charity that you're trying to do something with? What do you want to do for your children and your grandchildren? Well, if you think of a single asset allocation and a single strategy for all of your money, you're likely to not achieve some of your goals because you're trying to achieve two very different things there. One is much more about today and maintaining a lifestyle, and one is about much longer term. If you apply a single strategy, 60-40 asset allocation across your entire
so like 60-40, 60% bonds or 40% equities, whatever it is.
Whatever it might be, in the past, if you looked at it that way and you apply that against your entire pool of assets, I think you are not understanding your objectives and your risk for each of those pools of money as well as you possibly could. So we're spending a lot of time with investors, with prospects, talking to them about their real risk, and we're getting at it much better than we have in the past by talking to them in those terms.
Now, one of the other things that you're doing is you're spending money by hiring wealth managers. You're hiring at BNY Mellon for the wealth management group. Tell us about that.
We are. We've hired about 25 people in the last 6 months. We're trying to increase our sales force this year by about 15%. So that's folks who are out there finding folks who are wealthy and looking for an advisor, or perhaps they're with another advisor. They're dissatisfied. Perhaps they've been self-directed and they realize maybe I don't want to go this alone. So we're growing our sales force by about 15% this year.
Have you looked at what makes investors want to change wealth managers? Is it just performance, or is there a comfort level too?
Yeah, it's definitely a relationship business, Pimm. So getting to know people, having people be comfortable with their advisor. But one of the things that we're trying to do is really get to the substance of what we can do for them. So lots of prospects, investors are asking us for a second opinion around their current portfolio. So they're asking us, they're giving us statements, many times they're giving us multiple statements, and they're asking us, can you take a look at this and help me understand?
Almost like a diagnosis or a checkup.
Exactly. It's a second opinion, and often that will lead to new business opportunities for us. But we're seeing more of that than we've seen ever in the past, I would say.
I want to thank you very much, Lawrence Hughes, coming to us as the Chief Executive of BNY Mellon Wealth Management. Appreciate your insights into trying to help people with their retirement.